We are live. Hey, Barry Wolfe.
Hello. Great seeing
How
you,
are
Beth.
you?
I'm great. I hope you are.
I
Happy
am awesome.
holidays.
I'm going to text and welcome everyone, and we will start. As you know, I always like to start right on time. So as the clock turns 6, we will start because we've got a lot. I'll be here in the office till 8:30 tonight, but I think
Man,
it's going to go very
got
fast,
some great speakers, great guests coming on. I know.
just like
On a
you.
great topic.
Great topic. A
Yep.
topic that is near and dear to our hearts since we live
Yep.
here,
Yep.
right?
For sure.
Okay, it's 6 o'clock. We are going to start. My first guest tonight, this is for those of you joining the Miami market update. And why did I do this? I did this because I was in Dallas a couple of months ago and everyone was flocking to me. Tell me about Miami. Is it as hot as everyone says it is? Florida seems to be on fire. I was in New York last week. Same questions. What's going on down there? And I thought, well, let me get some of my friends together and let them give you all the responses that you are asking me about, because they're the experts. I'm a tiny bit representative of South Florida, owning my 5 shopping centers, but I figured I'll get Barry, the single tenant net expert. I'll get Lyle, who's high street retail and luxury retail. I get Tere Blanca with office, Chris Drew lending, Larry Genet industrial, Mitch Feldman self-storage, and Michelle from luxury sales. So a big night ahead, and we're going to just jump right in, Barry. So tell the audience, you're with Marcus and Millichap, Senior Managing Director. How was 2022 for you?
We've had a good year. I mean, it was definitely, I'd say, first half loaded to a degree, which I kind of anticipated going into the year. I thought, and we can get into this in predictions for 2023, I thought 2022 would be a really good year for what we do, which is investment sales of net lease properties and shopping centers. We do net lease all over the country. We do shopping centers predominantly in Central and South Florida. I thought this would be a year where, the inch cap rates and market velocity would be stronger the first half of the year than the second half of the year, because this time last year, to me, it seemed pretty obvious that interest rates would be going up over the course of 2022, which is obviously what happened. Therefore, cap rates and the market would trail, and therefore I thought the market would be stronger the first half of the year than the second, and that's what happened. So we've had a really good year, and we're still trading deals. I mean, the market has quieted a little bit. And we'll talk about less in Florida than other markets, as we're going to be talking about. But it's been a very strong year, and I think I'm excited about looking forward to 2023.
Yeah, and you guys sold a shopping center for me a few months ago, right?
We did.
Great cap rate. What we thought, we didn't really have any correction. It was just at the start of the interest rates going up. We were kind of holding our breath, but we got what we were looking for. So I was very happy.
I just say we did that. Timing could not have been better. I mean, that was right as interest rates were starting to increase. And now I think that'd be a tough number to replicate in reality, just because interest rates are probably several hundred basis points higher than they were when we traded that just, what was it, a couple months ago? I mean, when you're talking larger multi-tenant shopping center or any larger sales, interest rates impact that. They just do. And I think that'd be tough to replicate that pricing today.
So what percentage of the buyers that buy your listings are 1031 exchange buyers?
I think probably about north of 80%. So very significantly driven by 1031 exchange capital, which is, is larger sales. I was gonna say dry up, but that's far too strong of a word. But as larger sales decline to a degree, that does trickle down and impact 1031 exchanges. If you don't transact on a sale, you obviously are not going into a 1031 exchange. So I think we're going to see that decline a bit. I've been telling folks, I mean, you and I were both in the business and for a long time, but certainly 2009, 10, 11, 12, that market just was dead. I mean, for a couple of years there, transaction velocity was off 90+%. I don't think anything we're experiencing now or will see in 2023 is remotely comparable to that. So I think we might see a slight decline in transaction velocity, but nothing like the great financial crisis back 10, 15 years ago. I don't think we're anything in that sort of velocity area at all.
Well, I agree with that. And tell me with 1031 buyers, how so they have the cash.
Mhm.
90% of the time, they're just rolling their proceeds into a new deal. Are, they're not getting loans unless the 1031 is a partial investment of the new deal,
Right.
right?
Some of them do get debt. A significant portion of the buyers we're working with, particularly in single tenant deals, have been and are all cash. Again, when you get into larger transactions, whether that's single tenant or multi-tenant, like you and I worked on, you do tend to get debt involved. But at the same time, I mean, we've got a $12 million single tenant deal under contract closing later this month in New York, and that is all cash. So we've, even larger transactions can certainly be all cash, but as you get to larger price points, they too tend to, get a little bit more in line with debt involved.
Right. And then that's when interest rates come into play, right?
Correct. Correct.
What are you seeing a cap rate changes with single tenant deals right
We
now?
have. I think we're seeing some movement. I'd say over the last probably 60 to 90 days. I'd say on average, we've probably seen 25 to 35 basis point increase. And I think my gut feel is looking out into the first half of next year, the first quarter or two. I think we see similar, maybe another 25 to 35 basis point increase. We anticipate another Fed fund rate increase coming here shortly. The speculation is now 50 basis points, though I think some folks are still anticipating maybe it's 75. And I think the expectation is we see probably one more increase early next year. Now the thought is probably 50 basis points, and then hopefully that's it for a while. And I think I've always been a believer, uncertainty in any economic cycle and anything to do with the economy and real estate, certainly uncertainty is the worst thing in the world. And we've had a lot of uncertainty, and I think that's impacted the market and the economy. And I think we're very close to having some certainty, even if it's that rates are higher. Once folks realize, okay, the Fed announces we're done for a while raising rates, now we can all figure out how do we do deals. And that even if interest rates are higher, maybe cap rates are a little bit higher, you get into private lending and other sources. So there's a lot of ways to get deals done once there's some more certainty. And I think we're real close to having that. And even just the last 2 weeks, we've seen offer velocity really spike compared to the prior, say, 30 days when there was a lot of more uncertainty. Just we're starting to get that certainty. And I think folks are starting to get back in the market with more aggression than they were the prior month or two.
So yeah, I think it's going to be 50 on Wednesday when he announces. Wouldn't it be great if he, gave us all a present and said there won't be any more increases after this?
That'd be great. I think that the market would soar. I don't anticipate. I think the expectation is we're going to see at least one more rate increase. But even if that, I mean, I think the market's kind of baked that in. So I don't think that's too much of a negative at all. So I think we're all expecting that. But yeah, that'd be quite a present from the Chairman Powell.
Well, I think it will be interesting to see what CPI comes in at tomorrow, right? And if CPI drops again, you never know. And I think that we'll see what Christmas sales do in retail. That will also play into what they do, in the next Fed meeting also, I think.
Absolutely.
So are you seeing, we're talking about South Florida, the state of Florida. We were talking before we got on the call. Share with the audience, I'm pretty astounded what you shared with me, how you thought the cities in ranking kind of shifted recently. And I guess in the last year or two, share with the audience what you think.
The last couple of years, I mean, going back a few years, I mean, South Florida has always been, or at least in recent history, the last probably decade or longer, has been really, really hot. And I always looked at it, the further south you were, the stronger it was. Miami was a little bit stronger than Fort Lauderdale. Fort Lauderdale was a little bit stronger than Palm Beach. And now, I think the last few years, South Florida kind of gets lumped together. Maybe Dade's a little bit, it's a unique animal. It's a very different culture, and it's kind of viewed a little differently from capital coming from overseas. So you've got Tri-County, Miami-Dade, Broward, Palm Beach County, I think are viewed very strongly from investors coming out of the Northeast in particular. And one stat I'll throw out with you, we've seen just with our company in recent years, outbound coming out of the Northeast market, $7.78 billion in capital leaving the Northeast market, coming to the Sun Belt states. And Florida is a huge beneficiary of that. And inbound in the Southeast, you've seen $9.2 billion of capital coming into the Southeast, and Florida being a disproportionate beneficiary of that. And what I think what we've seen the last couple of years in particular is Orlando and Tampa. And it's not that South Florida has gone backwards at all. South Florida has progressed. South Florida has only gotten stronger. But Orlando and Tampa, in the eyes of investors and the economy in general in those markets, I think is now on par with South Florida. And now I think you've got kind of Central Florida South. And frankly, I think when the Bright Line opens up in the next year or two, you're going to see, I think these are all going to become one economy to a degree, where kind of Central Florida South all blends together as one massive, very, very strong economy, one of the strongest, if not the strongest in the country. You have similar rivaling Southern California and the Bay Area in California. I mean, I think you're going to see that happen. And it's really, we're seeing that where Orlando, Tampa are as strong as anywhere in the country right now.
So tell me those numbers again. You said 7.78 billion is coming in from the Northeast.
Coming from the Northeast, and I say disproportionately, that's the New York market. And then coming into the Southeast, the Sun Belt, $9.2 billion. And disproportionately, I think you see a significant portion of that, Florida, as compared to the Sun Belt does not include Texas. Texas is kind of its own area, but you're including Georgia, the Carolinas, Tennessee, which are all great markets. And there's been a tremendous flight of capital to the Sun Belt region in general. But Florida is definitely the biggest beneficiary of that, particularly capital coming out of the Northeast, New York, New Jersey. So many of those folks have second and third homes in Florida. They understand the market. They've got friends who already live here. So Florida is a huge beneficiary. And we were seeing capital flooding in the market into Florida from the New York area pre-COVID. And that's only been exaggerated since COVID. I mean, we all know, we've got a lot of friends and folks we know that literally picked up and left New York areas and moved to Florida. And we've seen folks that are doing that with investments and literally just buying, first homes, second homes, and whether they're leaving New York permanently or coming out as a second home. We've been a huge beneficiary of that, where frankly a lot of clients and folks are just taking capital out of the Northeast and moving it to Florida.
Well, so two things. One, we've got Tony Burke is asking, do you think St. Pete is as strong as Tampa? Do you consider it one?
I'd say, well, you've got the Waterside project. You've got some enormous projects in the downtown Tampa area, but yeah, St. Pete as well. I mean, I would say right there on par. I mean, there's a lot of talk about the Devil Rays, the redeveloping that project, the waterfront. So St. Pete, I do see mentioned by a lot of folks as being a very, very strong market. St. Pete, Clearwater, Tampa, Lakewood Ranch, Bradenton. I mean, that's a very, almost the size of not quite the Tri-County down here, but Tampa's market is enormous geographically, and it kind of bleeds over to Orlando.
And it will be very interesting to see what happens as a result of the hurricane. We all know what happened here in 92 with Andrew, right, where Broward County became what it is today, Pembroke Pines, because of Hurricane Andrew. So that whole Bonita Beach, Fort Myers area, those people need to go somewhere.
No, you say that, but those areas are still on fire. In fact, I was reading an article over the weekend from Redfin, and it was ranking based on searches. Where are people that are looking to relocate? Where are they searching? Where do they want to relocate? And 5 of the top 10 markets are state of Florida, Miami being first, but then Tampa actually being second. They're number 5 overall nationally, but then Cape Coral and Northport and Orlando. So wow. Cape Coral, Fort Myers is still... that has not scared people away. I mean, you get a lot of Midwesterners. You're supposed to be in Cape Coral, Fort Myers, if you followed your roots. A lot of folks from Chicago, Milwaukee, those states tend to gravitate more to the west coast of the state, more so than South Florida. So you're a little unique. I don't know what it was like back then, but no, I mean, the West Coast.
I followed the Cuban boyfriend. What do we were on this.
Okay,
side.
There you go. But no, I mean, a lot of Midwesterners really still, I think even after Ian, I think it'll take another brutal hurricane before that would even possibly shift. But no, West Coast, Cape Coral, Fort Myers, Northport, those areas I think are still as strong as they were pre-Ian. I don't think that changes.
Well, so I have a stat for you in response to your stat you gave us. Uh-huh. Where is it? In 2022, $24 billion of wealth came to South Florida.
Yep.
From the Northeast and California, $24 billion of wealth.
Yep.
The next largest influx of wealth was Texas at $6 billion. So $24 billion came to us and $6 billion went to Texas.
in the outflows from California to Texas largely, but also Florida, and then Northeast to Florida. I mean, the outflow of that is huge amounts of wealth leaving New York and coming. If it's leaving the Northeast, it's largely to Florida, much more than Texas.
We got a lot of people commenting on politics, which we won't go there.
Right.
Talking about Florida and our politics and
it's definitely politics are part of it, and not endorsing any, but also weather. I mean, it's definitely forgetting the hurricanes, but that's part of it. But politics and just the openness of it are absolutely part of it. And also just so many Northeasterners already have family and friends that are down here. And if they're wealthy, they may even have already had a second home or came down for vacation. So it's a very comfortable cultural shift for folks from the Northeast to South Florida. And again, from the Midwest to the West Coast of the Florida. Again, it's a very, very comfortable cultural shift. And that, I don't think you can underestimate that either.
For sure. Okay. So predictions 2023. So what do you think about cap rates for single tenant deals? Are they going to go up and then go down? What are they going to do?
As I said, this time last year, I really felt like this would be a front half loaded year, that cap rates would be stronger the first half of the year than the second half of the year, that market velocity would be stronger the first half of the year than the second half of the year. I've been saying it's as a prediction, I don't feel quite as comfortable with this as I did last year. I think next year is a mirror of this year. I think the first half of the year, the second half of the year will be stronger than the first half of the year. Cap rates will be trending downward, meaning compressing the second half of the year. Interest rates, I hope, will be decreasing or declining the second half of the year. So I don't think the first half of the year is going to be a lost 6 months by any stretch. But I do feel like we will see a stronger second half of the year. Typically, from a velocity standpoint, first quarter tends to be the least velocity of the 4 quarters in the year. Fourth quarter tends to be the strongest. This year, first and second quarter nationally were stronger than the fourth quarter. This has been a unique year. And I think first quarter will still be a little slow next year. I think it will ramp up second quarter. And I think third and fourth, I think will be very, very strong. I think it'll be kind of a mirror image of this year.
Well, and I think the closer we get to the presidential election will definitely impact the interest rates.
Likely. Yeah. We talked about that in the last election. Correct. I think you're right, where you start to get politics involved and you start to get some pressure on the Fed to lower rates. And I think just the economy, hopefully inflation will be lowering. And I think there'll be reasons, whether we get any decreases in the Fed funds rates, hopefully the second half of the year. I think you'll just see interest rates start to normalize with lowering of rates the second half of the year, I do believe.
So, of course, since I'm in retail, which is the most in-demand single tenant right now? So if someone calls you and says, forget the cap rates, which is the most in-demand tenant?
Cannabis. It's all about cannabis.
No.
It's actually, that is in demand. The most in-demand tenant on single tenant side, I'm going to go maybe like Chick-fil-A.
I thought you'd say either Chick-fil-A or Wawa.
Wawa is very strong. I mean, fast food, C-stores, absolutely. I mean, I would say Wawa, Racetrack, fast food, Taco Bell, Chick-fil-A, Chipotle. It's kind of the brands we all know. And we're starting to see those cap rates come up just a little bit, but just strength of strong tenants. I mean, and Wawa, absolutely. I mean, I wish I had a dozen Wawa deals right now. I mean, they're very much in demand. Again, those strong C-stores, QSRs, cannabis, any of the strong operators, absolutely. Yeah.
So I'm going to ask you the final question, which you know what it is. But before I do that, how can people reach you? What's the best way for them to reach you?
Right, easiest, look me up on LinkedIn, shoot me a direct message. I don't hide. I'm easy to find.
Awesome. Okay. So the last question, I'm going to ask everyone this. Mm-hmm. South Florida, are we going to have a recession?
What I've been yelling and screaming about it, I just wish the media would shut up about a recession. I mean, there will be a recession, whether it's next year, whether it's now, next year, the following year. The media makes this out to be like, oh my God, there's a recession coming. The economy is doomed. We have a recession every 5 to 6 years on average. You and I both have been through multiple recessions. I think people just need to chill out. I mean, let the media, I guess they've got to get viewers, obviously, so they got to talk about a recession. There will be a recession in South Florida nationally. I don't know that it'll be next year. I don't know when it will be. There will be one, but the sky is not falling. Every recession is not. In fact, the last time we had a recession like 2008 was in 1930 some odd. It was the Great Depression. So the next recession does not figure to be anything like the Great Recession. I don't personally, if we do have one next year in South Florida, I'll let you go because I know you had others. I think it will be light. I don't think it will be anything like we had back in the last recession was brutal. It's kind of what's on our mind. So we're scared to death of it. So that's why I think people are fearing this next recession. I don't think there will be much of one next year, but again, don't let that drag you down. Don't let the media, don't play into the media. Don't feel like you can't get out of bed when we finally do have a recession, because there will be a recession somewhere around the bend, because there always is.
Eddie Gonzalez said he likes that. He likes Barry saying, chill out. In the last, I watch CNBC every morning, and in the last 5 days, they have completely changed their tune and are now talking soft landing completely. Right. They've done a 180, which is great, which is what I've been saying forever.
Yeah, because I am a believer. I mean, a self-fulfilling prophecy can be a recession. If we all get afraid of that, we all stop spending, and GDP goes down, there you go. We're in a recession. I mean, that's what a recession is.
You're not stopping spending, right? You're going to New York this weekend. I was just there. I spent a lot of money. Go spend a lot of money.
Sounds good. Thanks, Beth.
Happy holidays.
Everybody.
Thanks, Barry.
Thank y'all. Bye.
Lyle Stern. Let me see.
Hey, Beth Azor.
How are you, sir?
Doing great. How come I didn't see you in New York?
I don't know. There was a lot of people.
We were supposed to have dinner, right? And then there were too many people.
Exactly. There were a lot of people that I did not run into that I know were there, and it was a very electric conference. We are talking about the International Council of Shopping Centers. They don't even call it that anymore, but the ICSC in New York last week. Probably one of the best shopping center conferences I've been to in my 36 years of doing this. It was so electric.
Agreed. And the herd was thinned and it was robust. And I believe that everybody that was there, it was not inexpensive to go to New York. I think everybody that was there really was in deal making mode. Either had product, had capital, had tenants. Most of our tenants were represented there. Almost every landlord we worked with in South Florida was represented there. So I think it was quite robust.
So people are commenting they're having a hard time hearing you.
Okay, let me pop these off.
So let's make a change there because we want to hear every word. Say it again.
How's that?
That's better. Okay. So Lyle Stern, president of Koniver Stern, been in the business almost as long as I have, about the same 36 years I'm going on. And you are the expert of what I call luxury retail and high street retail. So tell us about 2022 in Miami and South Florida for you and your clients and your landlords.
So our area, by the way, thanks for having me on. It's always great to see you, even if it's electronically. Our area of focus generally is Dade, Broward, and Palm Beach. We do things around other parts of the state, but I think those are the areas that we understand really, really well. So we get to see it through the lens of our tenants. We get to see it through the lens of new developments. I've been doing this over 30 years. I've never seen the robust level of activity spurred by COVID. There's no question. We all know all the reasons why, the migration that occurred down here. And I remember when, they started closing the borders and, things were falling apart, and we were on the phone with our lenders and with our tenants and, holding everybody's hand, never expecting that we'd be coming through this trans-COVID and post-COVID period the way that we are. But what we're finding in our world is this nodal activity, that there are areas that were really not on the development horizon before COVID, or were on the slow development horizon during COVID, that are just erupting. Some of them we're all familiar with, whether it's Wynwood, Design District, Brickell, South Beach, Lincoln Road, south of Fifth, Bal Harbor, Sunny Isles, Aventura, almost any place you touch in Dade County, Doral, where we're actively engaged in some development work. But downtown West Palm Beach has been not a huge surprise, but a huge velociter. What's occurred both on the island in Palm Beach, again, because lots of people were living down here, the restaurants were full, especially during COVID, and we're seeing that lingering effect afterwards, where you would have thought that areas in Palm Beach would go back to where they were pre-COVID in terms of numbers of people that are here. But the reality is offices have moved, offices have shifted. And we're seeing in areas like downtown, so that's the island of Palm Beach, downtown West Palm Beach with Related's project, and it's been Pac-Man as they gobble up office buildings around them because of the demand that they're seeing from the translation coming from predominantly New York, some Chicago, but the New York metro area, and the open to buy for office space they have, the amount of office space that they've acquired and are adding, the level of activity with F&B that has committed to go into Rosemary. And we're seeing that now also in Nora, which is a development area that probably most listeners and most folks aren't really familiar with. It's an area just north of where Rosemary is in downtown West Palm Beach.
What's it called?
It's called Nora, Nora. And it's a development group. It's Wheelock Capital. It's Joe First, who was a disciple of Tony Goldman. And they've recently announced that Richard Bourne, who's a prominent New York hotelier, the Bowery and the Mercer, has joined their development team as a partner. They'll be making some pretty substantial restaurant announcements. I don't want to get ahead of their messaging, but what it's done is it's shifted us into looking at that project, the project that, while we believed in, weren't sure of what the timing was, and the announcements that they were going to make in the near future create that as another bullseye in Palm Beach. So, and Palm Beach is this amazing market because it's Boca, it's Wellington, it's Jupiter, it's it's DeQuesta. So it ends up being the gravity model in the northern part of Palm Beach County. So we're seeing these nodes. Wellington is as strong as it's ever been. Palm Beach is as strong as it's ever been. What's happened on Las Olas and Fort Lauderdale and Flagler Village and along the Las Olas River, and just the thousands of units that are in the development pipeline, thousands in each of these markets. I mean, what we've seen happen at Flagler Village is pretty spectacular. And the level of developers and where they're coming from and the units and the unit sizes. And that continues all the way down, really east of 95, all the way down, to even what we're seeing now in Homestead. Clearly not an area that has the level of luxury retail, but a level that almost every neighborhood retailer is looking at. So when I take a step back and I look at the mass migration in, the mass horizontal development, the intense vertical development that's occurring, again, east of 95, and then when I dive into the micro markets, and the beach I know like the back of my hand. So when I look at Lincoln and Collins as a perfect example, and I look at the Ritz-Carlton doing a 100-room expansion, the Witkoffs of Monroe Capital buying the Shore Club and doing a magnificent Robert A.M. Stern residential tower on the ocean, and taking the Shore Club Hotel, the former Shore Club Hotel, where we all used to go to Nobu, and announce that they're doing a hotel with auberge from Napa in the front. And Michael Schvo and what he's doing at the Raleigh and the two adjacent properties with the Rosewood Hotel and residences and the Bulgari Hotel and the Amman Hotel. So we've got billions of luxury residential development that is underway, either approved or underway on the eastern part of Miami Beach around Lincoln Road. They'll have this incredible bleed over impact into our shopping districts and our restaurant districts. And we quote restaurant rents in South Florida like we're handing out apples. I mean, it's nothing for us to say, this one did 12 million, this one did 15 million, this one did 18 million, this one's doing 30 million. Whether it's, Gecko, Pappy's Steak, Milos, Mila, Joe Stone Crab, the major food guys with Carbone and Hassalan and so we have this incredibly robust nodal Southeast Florida development with lots of neighborhoods. It's not like there's one go-to. It's almost like New York with all of its neighborhoods in Manhattan, and then you add, Dumbo, and you go to LA, and LA's got 50 different neighborhoods. So it's a long way of saying that we're bullish. We are out of great space in certain markets for tenants who have to wait for the next round of development to come out of the ground and are looking to pre-commit. I'm incredibly comfortable, and I say that carefully, because part of what's driving our economy is also the shift of office space to Southeast Florida. And even with the conversation you and I saw in New York, you could just feel in the streets that people weren't necessarily back in their office. But when I look at the office commitments being made in downtown West Palm, downtown Miami, Brickell, and South Beach, and who's signing leases and who's moving here and who's moving capital here and who's moving their offices here, it triggers a few things. One, and I've really learned this from our office broker friends, is those firms, whether it's Citadel or Thoma Bravo or Blackstone or Uber or whoever else is coming to the market that's either new or expanding, a lot of their C-suite executives haven't moved here yet because the buildings aren't done yet. So that's a migration that's going to continue. We look at 830 Brickell, almost 1 million square feet. It's 100% leased at rates higher than they ever expected before the building is completed. And those folks, for the most part, haven't moved here. Yes, some of them are just trading buildings, but the far majority of that space is new to market space.
Right.
So there's a lot going on here, and all that drives retail and restaurants, which is how I see the world.
I have a note to talk to Tere. Blanca. Someone told me 2 million new to market office users signing leases, 2 million square feet.
Well, listen, the 830 Brickell is 1 million in and of itself, not counting, and Tere knows much more than I do, but not counting Wynwood Design District.
Right.
South Beach, Michael Schvo is developing 2 brand new buildings, one designed by Norman Foster, one designed by Peter Marino, and is reskinning an office building on Lincoln Road with Norman Foster. So, and again, Tere knows more than I do, but what we're finding is there are a lot of people living on the beach that want an office on the beach. A lot of wealth has moved here. So we're all very fortunate to be here.
Yeah, I don't know if you heard me when I was talking to Barry. The stat that I heard was $24 billion of wealth moved to South Florida during COVID compared to Texas, which got 6. So let me ask you, you said we're running out of space. I'm on these calls all the time with South Florida brokers, landlords. We have our think tanks. No new development. So are these projects that you're naming off left and right, are they going to have ground floor retail, which frankly, pre-COVID, you would agree, ground floor retail, which was the tail that wagged the dog, sat empty for a long time because it wasn't no ventilation, no grease traps, etc. You're now starting to see those fill up because we're running out of space. Exactly what you said. So are you seeing retail developments? We're not seeing a lot of flat developments. Everything is vertical. So what's your thought about that? And then I've heard recently, I was at ICSC in Delray 2 weeks ago and talked to an F&B broker, and he said, I have not done a restaurant deal without key money in the last 6 months. And I haven't heard that term since, the 80s or 90s.
Yeah,
so,
that's fair.
So 2 things, new development and key money. Chat about those 2 things.
So we're seeing a lot of new developments. They're larger in scale than we're used to, but smaller in scale compared to other places around the country. So whether it's Design District, Wynwood, Brickell, South Beach, Palm Beach, because you've got to go vertical just because of the cost of the land and the opportunity, because a lot of things were built single level because there was really no reason to go vertical. But now we're finding a lot of single level retail centers being demolished or parking lots being built on because there's a strong need for either office or residential or medical or integrated, senior housing. So we have lots of pockets of new needs in our market as well. It's not just retail or office that creates this. So I think we're going to see more and more vertical development. And I think that the developers that will be the most successful will be the ones that engage, great development consultants and brokers to figure out how to pre-plan that space. So the columns are in the right space, the vent stacks are in the right place, the grease traps are in advance. There's a lot of pre-planning. You and I have seen it, that good space in good markets is easier to lease than bad space in good markets. So I just had this conversation with a developer before I joined this call, where he's ready to break ground, and he's saying, when should I hire a broker? And I said, last year, and the plans need a lot of work. So I think
I had a developer call me and said, I'm having a hard time leasing space. I said, well, that's a problem in this market. And it's down the street from a property that I own. And I said, well, send me the site plan. He goes, oh, I said, oh, that deal. I said, yeah, I know your problem. On the main, it's on a main street, 50,000 cars, and then a perpendicular tertiary street. The residential developer put the water retention on the main street and built the retail on the tertiary street.
Of course.
I said,
why wouldn't you?
You're going to continue to have a problem leasing that sucker.
So important to plan these right, because we're going to see more and more of them. The good news is that I'm finding that the level of sophistication of the developers, like the architectural community, will catch up. And we have amazing architects here, but it's opened the door to great architects from around the country that have great expertise in developing these types of communities and structures, especially since the majority of developers we're seeing are coming from outside of our market as well. I mean, we look at Miami World Center. Not so sure there's a developer there that was here before. And I think that's a good thing, actually.
Okay, so you want to chat about, is it true? Key money everywhere?
You know, we haven't seen that much, to be quite candid. We leased not an insignificant amount of restaurant space in our markets during COVID. There was no key money. Landlords were just happy to have tenants.
Right.
So now, because the bulk of the space in the better markets that we work in is gone, there aren't a lot of transactions. There's not a lot of space left. If I had a great space on Brickell tomorrow in a restaurant space, would we get key money for it? I believe we would. No question.
And someone told me Brickell rents for retail are north of 130.
Yeah. I mean, we've seen restaurant rents north of 100, retail rents north of 130. We've lost deals for tenants of ours in competition with other tenants that it turns into a bidding war. I'm not so sure the last time we saw that. But Beth, I would tell you the other thing. Some landlords really think it through. Almost depending upon where they are in their deal cycle, better to have more rent than key money because of cap rate and selling price.
For sure.
So, you know, pick, do you want key money or do you want cap rate? It depends when you're going to exit and what your needs are.
For sure. Well, you know, I forgot what I was going to say. Oh, damn it. I had a really good idea. Well, so my question I'm asking everyone, and then when I remember, I'm going to come back and ask you the other thing, is recession in South Florida. Are we going to have one, and what are your predictions for 2023? And in that, will there be a recession in South Florida?
So I think that generally speaking, you know, people get concerned about spending money when they're concerned about a recession. I think we have an incredibly affluent base in South Florida. When we talk about South Florida, big area, I'm really talking about 95 East for the most part. I mean, we have great pockets like Weston, Doral, et cetera. But generally speaking, I find that we have so much flight capital here and so much commitment to open offices and so many real estate transactions coming that if we do have a recession, other than interest rates continuing to tick up, which will impact all of us, I think it will be tough to feel. Really do. Now, you know, it's all income based as well, right? I mean, if you're making, you know, less money and you're concerned about spending money, then it makes all the sense in the world. And I don't mean this, you know, I say this kind of tongue in cheek, but if the decision is on buying, you know, four Rolexes versus 5 Rolexes this year, it's different than am I buying groceries. So I'm sensitive to both ends of the spectrum. So
for sure.
We have
I remember what I was going to say. So I have tenant rep brokers calling me now, asking me about future expirations, like 26 and 27. And you know, tongue in cheek, I say, if I had it, I wouldn't start negotiating now. But are you seeing that? People calling landlord, you know, they're saying, do you have any weak tenants or any tenants moving out? It's just crazy what's going on right now.
So we're working a few deals where the opportunity is when a tenant doesn't have an option, there's an opportunity for them to get paid to leave earlier. Is it worth it to them? So that's something we haven't done a lot of before that we're getting quite a few calls on now from both landlords and tenants. Tenants that know that their space is worth more than they're paying and the landlord would love to have it back. And landlords that know that they have tenants with, you know, sub 5. We're actually working on one lease that has 4.5 years left that we have a tenant who's looking to buy out. A tenant is in possession that is looking at it and saying, this may not be such a bad idea.
Excellent. Well, I like that story. So tell me about, you remember a few years ago, you were working on the market that's north of Wynwood. What was that called?
So it's Wynwood Norte. If it's west of Biscayne, right? So Wynwood Norte sits between Wynwood and the Design District, west of Midtown and east of 95. And it's an area that's gone through some rezoning and will be the next to go through some gentrification. I think the challenge here is really the need to accumulate several folios to make it worthwhile.
Right.
But like Buena Vista, I think we're going to see an uptick in the quality of the residential there as well because of the level of investment in single family homes.
So is anything keeping you up at night in the South Florida commercial real estate retail world as a landlord or a tenant broker?
So as a landlord, I worry about interest rates as we have mortgages that are rolling.
The next speaker can help you with that.
I think that's probably the biggest issue. Yeah, other than that, quite candidly, it's being in the competition for new and emerging markets. You know, we're super excited about Alapata, where we've
Alapata. That's the one I was gonna.
Yeah. Alapata is on a great growth trajectory. It's really where the larger bone museums are landing. The Rebel Museum, of course, 150,000 feet with a Le Coup restaurant, which is Jeff Chodorow, Super Blue, which is owned by Pace Gallery in New York. Photographisco, which is the largest private art photographic museum in the world, is landing there in a David Rockwell designed building. So, and there's been a significant amount of F&B interest in Alapata. And there are two residential buildings, one that Lizette Calderon is already out of the ground with, and one that Sheldon Lowe and Tom Calabrese are about to break ground on. So, it's a lot going on in Alapata.
So, construction costs, you've named probably 50 developments. I had no idea. I need to just spend more time with you.
I love that.
So the construction costs you're not hearing is slowing anything down with all these developments.
I'm sure it is. I'm seeing some projects be redesigned a bit, but I'm not seeing them slow down. I think the expectation is that rental pricing will move up as well. I'm seeing some projects that were designed as rental buildings that will now be sold as condominiums. But I haven't seen a slowdown yet, but I'm not sure that I'm close enough to that side of it.
Anyone coming back to you, to your tenants and saying, hey, we signed this lease 9 months ago. We just got our construction costs. It's insurance, 30% up everywhere. We need more rent. Any of that?
Yes. And you know, I haven't had a tenant that is sympathetic. The traditional tenant response has been, and as you know, we represent some grocers. The traditional tenant response has been, our cost of construction has gone up as well. Our cost of goods has gone up as well. Our cost of deliveries has gone up as well. So we're suffering the same.
Okay, so Lyle, this has been a pleasure. I do need to come down and spend some time with you.
Please do.
But how can people get a hold of you if they have a client? You know, people are watching this from all over, and they might be wanting to come to South Florida, and and it might be an F&B concept, and obviously you're the guy. So what's the best way for someone that wants more information or more Lyle Stern to get you?
The absolute best way would be to call me or text me, 305-785-3863, 305-785-3863, or just email me at Lyle, L-Y-L-E, at KSGRP, Kilo Sierra Gulf Romeo.com. We're going to be changing the company name coming January 1st, but it'll automatically roll.
So I just put your number in, 305-785-3863.
Yes.
All right. I just put that in the chat. So love you.
Beth, thank you so much. Please come down.
Happy holidays. Yeah, you have to take me to one of these restaurants that all have all of these fancy names.
Come hungry, we'll go to all of them.
Bye, Lyle. Thanks so much.
Thanks so much.
Bye-bye. All right, Lyle, I think you need, I'm going to close you out, Lyle, remove from stream. Chris Drew.
Hey, Beth, how you doing? By the way, I want in on that invite for the restaurants. I feel like Lyle has great places. So wherever he's going, I want to be there.
Well, and now I'm going to connect you because he's got loans rolling. Did you hear that?
I did. You're like unbelievable. I mean, this is business development right here, everybody, real time.
So I think you need to, he'll pick the restaurant, you'll buy because you'll get a loan renewal out of it. And
Exactly.
everyone, and I'll
Exactly.
just come along for the ride to be the
And
connector.
yeah, exactly. And you get, yeah, exactly. You get the dinner and the company and all that other good stuff. So
Exactly. All right. So thank you for being here. Chris Drew, co-head of the Miami office of JLL and senior managing director and all things lending.
yes,
Yes.
ma'am. Yes. Yeah. So they say. So they say.
So I asked around and I said to people, I need a lender. I need someone in the mortgage brokerage business on this call because we can't have all, what is it? Sunflowers and, rainbows on this call.
Yeah,
We need to have
exactly.
someone to kind of bring us down to earth.
Oh,
So you get to be that guy.
well, I mean, I hate to be the bearer of bad news.
We got to
But
level it out a little bit because everybody else is going to be super optimistic and super bullish. So you're the guy. So fill us in on 2022, which probably the last, 8 weeks have been kind of a downer.
yeah. Yeah. So how much time do I have here? 15 minutes?
15 minutes and give or
All
take.
right.
I see
You got it.
the next guy coming up. So, but I want to give you your
Okay.
due. So
No, I appreciate that. So listen, I mean, I think we were coming off of a record 2021 in terms of transaction volumes, both on the sales and debt side, pretty much across the board. Obviously, I do a fair amount of retail, but I do all other asset classes as well. And I can tell you that, the other asset classes was a banner year in 2021. And then we started the first half of 2022 with, the thought process that the Fed would probably look to start slowing the economy to stem some of the inflation, which unfortunately I think the Fed initially thought was transitory, which it's proven obviously not to be transitory. So I would say that through May of this year, the market was really moving. Maybe even through April, the market was really, really moving. Then we started to see some cracks in like that early May period, and they started to form, and they started to form pretty quickly, primarily as a result of what was happening with the Fed starting to increase rates. And I think now you look at it, and there's a trajectory where short-term rates are probably going to be, and I'm talking about index rates, right? So 30-day overnight SOFR is probably going to be somewhere in that high 4 to 5% range. To put it into perspective, when we started this year, I was negotiating SOFR floors of 25 basis points.
wow.
Okay. So, I mean, I think the veracity of the increase in rates, that's really what's been so challenging for the market. I mean, and again, rate hikes started 8 months ago. The average for those, right? So when you go through these periods where the Fed tries to, take air out of the economy, that's typically 23-ish months from the start to where it plateaus. And we're about 8 months in. It seems, from what Jerome Powell is saying, it seems as though you're probably going to see another 50, maybe 75 basis points coming this week, and then I think you're probably going to see another increase coming in the in Q1, early Q1. So that's going to get you very close to a SOFR index rate of plus or minus 5%, and I mean, it's very hard for the marketplace to absorb that. We are dealing with what they call an inverted yield curve, which that does signal a recession. I think there's an adage that it's signaled more recessions that have actually occurred, but every time there's been a recession, there has been an inverted yield curve. So I would say in this juncture, I think the duration of which we're looking at this higher interest rate environment for particularly the short end of the curve, right? So that, call it 2 to 5 year borrowing range, which most of our clients, like to borrow in because it provides them a flexibility. I think we're going to be looking at an elevated environment for that. And you'll be looking at an elevated environment for floating rate money. And then what you are starting to see, which has been quite interesting, is you're starting to see the long end of the curve come back in a little bit. So, your 10-year treasury rate is somewhere in the 3.5% range. Your 5-year treasury rate is somewhere in the 4.4% range. So, and then, when you look at your 2 years, it's closer to 4.6. So, that's just, you're seeing this inversion of the yield curve, which that typically doesn't happen. But I would say, what we're finding today is we're finding the local and regional banks and the small life insurance companies are still getting deals done. So, that's been we're doing deals today with groups that in the 15 years I've been doing this, I had never met before, but they're doing a great job. So I love watching these smaller banks try to take market share. And by the way, they've done a sensational job. They're getting deals done. And it's frankly been a breath of fresh air for a lot of our clients to deal with. So, PNC and Wells and, Bank of America and, Citibank and all these other groups.
Valley. I've done 2 loans with Valley.
Valley's great. Valley has been sensational, right? So they're one of the smaller banks that they've come in and they're taking market share from the banks that I just named. And they've been a great bank, a great relationship for us and our clients. And they're absolutely a group that folks should be trying to do deals with. I think the issue that you're running into, and they'll tell you this, is that these guys only have so much capacity, right? So
absolutely.
For larger borrowers like you and others, I mean, you can get a couple deals done, but when we're dealing with clients now, we're constantly trying to find the next Valley.
Right. Well, Professional was great. I was looking at a deal to buy. I ended up not buying it, but Professional was very aggressive. So I'm sure you know those guys too. Yeah. So the uncertainty, we talked, Barry Wolfe and I talked about this earlier in the evening that, look, my parents in 1978 signed an 18% mortgage. Right. So it's, wow. I think we will adjust. Yeah. Wow is right. I think we will adjust. It's the uncertainty that makes people, purchasers, well, where is this headed? And, but I'm thinking what you're saying is maybe the people that want the flexibility have to either pay for the flexibility or they'll do long-term loans and remove the flexibility. Right. I said to someone the other day, I was looking at a deal to buy and I said, I'll sign the higher interest rate as long as I don't have a prepayment penalty, because I believe as it gets closer to the presidential election, rates will drop. They'll never go back, in my opinion, to where we had the luxury of the last 5 years, but they will level out. And as long as I can increase the value of the value add deal I'm buying and I can refi, that's kind of my plan.
So, yeah, listen, I think that's the strategy that most of our clients are trying to implement at this juncture. So I think the problem is that if you do a floating rate loan, then you have to buy an interest rate cap, and interest rate caps today, as you know, are very, very expensive. I think they're up probably 4 or 5x in terms of the cost over what they were at the start of this year, and that's just obviously evidenced by the forward yield curve, right? It prices off the forward yield curve. So if you want to do a floating rate loan, unfortunately that interest rate cap is expensive. So we do have clients that are, to your point, pivoting to longer term financing. However, if you do a 10-year deal, most banks today aren't providing 10-year financings. There are some that will, but most banks want to be in that 5 to 7 year range, and some will provide you with significant prepayment flexibility, some will not. It's like trying to find the quintessential needle in a haystack. And I would say that obviously we do a fair amount of business with life insurance companies, and the life insurance companies, they're match funding this loan to existing liability that they have, whether it's an annuity or whatever it might be, and they need that term. So their prepayment is just not as good. And they typically have a lower rate, but they don't have the same flexibility around prepayment. You can price it in and some will provide you a step down prepay, but it's, I would say that today we're probably calling and contacting on any given transaction we're working on 3 times as many lenders as we have historically, because I do this every single day. I mean, every day, this is all I do. And I can't tell you with a straight face who is going to be the ultimate lender for a particular transaction. I can tell you where I think it's structured and how I think it's going to price, etc. But somebody walks into committee on a Tuesday they walk out on Wednesday and they say, "Oh my gosh, like we're out of the market for the next month because the regulators have come in and said, to put a pause on lending."
So the silver lining for you is you've met all these new lending relationships.
Yeah. Yeah, no, listen, I mean, listen, I would tell you, it's great. And we love dealing with our local lending relationships, our life insurance companies, et cetera. Wells and PNC and these other banks, they're great, right? But I think that in this instance, it's been fun to watch the kind of smaller banks try to compete. And who knows? I mean, those are going to be the next City Nationals, right?
For
They
sure.
become,
Have you talked to what I keep hearing in my circle of friends that are buying or trying to buy? The credit union has come. Have you seen that? People.
We have.
I know 2 people right now are working with a credit union. They haven't closed yet, so we'll see how that happens.
Yeah, listen, I mean, I think the credit unions, obviously the size of the transaction matters. I think today big deals are very problematic regardless of the asset class. So I can tell you that, we recently closed, $100 million loan in Austin. And it was that there was not a deep bench just because there's not that many groups today that can write a check that size. I think if you can do a deal that's sub $10 million, that provides you with a lot of flexibility, and credit unions can play in those, local regionals can play in those, and it provides you with, an ability to get a transaction done. So what's been interesting is I think that, we're seeing a little bit of a pivot in the marketplace today to the smaller transactions as a result, right? I mean, there's debt there, so you can get them done.
And those are my deals,
Yeah.
So what do
That's
you
still a
think
pretty big
about,
deal, Beth.
I think so, but maybe
big,
not
yeah.
in the circles that you're rolling around in.
No. Well, I'm not buying them. It's not my money. It's always other people's money. You see,
But you need to buy.
I
You need to start investing.
I'm too busy. I do, but I'm too busy right now. I invest with clients' funds, but I'm just, I spend all my time trying to make sure that, you have the proper capital so that you can go on and do more great things.
Absolutely. So you just mentioned Austin. A question I had for you is, because we're talking about Miami and how hot Miami is, are you seeing lenders nodding? Oh, Miami. Yeah, we'll look at that because it's Miami or South Florida or Tampa.
100%. So, I mean, I can talk about all asset classes. I'll focus on retail right now.
You don't have to.
Yeah. So listen, I mean, I would tell you that I think retail throughout the state of Florida, there's sincere demand from lenders, whether they're located within the state or not, to come down here and put capital to work because they probably have clients that are moving to this market. So I would say over the last,
they've been underweighted in retail because of before COVID, it was retail's dead. And now COVID helped us. So now they have to increase their allotment. Yes.
That's spot on. I mean, listen, if you think about it, today, and we've really tried to, make sure that lenders fully understand this, is that today, if you have a functioning, well-occupied retail center, it has gotten beaten up. It's gone through COVID. It's gone through the retail apocalypse. It's gone through hurricanes. It's whatever challenge you want to throw at this center today, it's gone through it and it's performed, and it's probably performing better today than it ever has. So I think that's what's giving lenders a sincere interest in doing retail loans in the state, plus all of the positive net in-migration, and you can track the wealth that's coming down. So that should lead to better sales and better tenant health ratios. I would tell you that
sales are through the roof, over the 19 numbers, through the roof.
Unbelievable, right? Yeah.
So
listen,
what other asset classes are in demand for lenders?
Multifamily's always in demand. Yeah, I would tell you that industrial, it's got a very, those cap rates are still fairly tight, so the coverage ratios are challenging, and you have to finance it at a lower leverage. And then you have other esoteric asset class, the smaller asset classes like self-storage, student housing, seniors, etc. But office office is the one asset class that's been very challenging to finance as of now. I would tell you that Miami and certain pockets of Miami, we are seeing interest from lenders to finance office. It's not easy, but we're doing it and we're seeing it, and it's primarily just because of all the positive news around net immigration, and you're also seeing positive rent growth, and office down here is different than it is in 99% of the country.
Yeah, I'm going to ask Tere when she comes on, but I heard a stat of a net new to market 2 million square feet of office in Miami, and Lyle Stern said, I'm wrong, it's more. So I can't wait to ask Tere.
From just the names I've heard, it probably is. I mean, I think that, and Tere would be able to tell you. I mean, Tere actually hired me into the business many moons ago. So she's been a great mentor and friend, and she knows the market as well as anybody. So I can tell you that I think from some of the names that we've just heard, I mean, listen, obviously we were involved in the Citadel deal for selling them their land, and I would tell you that when you see a group like that come down to the market, I mean, that's a game changer. When you see groups like Millennium Asset Manager come down to the market, these are game-changing employers that are coming down here, and they're bringing very high-paying, very high-quality jobs to our marketplace.
Which is phenomenal. Okay, so the question I've asked everyone. Well, before I go there, your predictions. So you think there's one more rate hike in Q1 and then we're done? Is that
listen, I believe that there, depending on what happens with inflation data.
Yeah.
Well,
And
all of it,
retail
right?
sales.
I mean, yeah, exactly. Retail sales, but all of it, right? And obviously, it's counterintuitive because you really want the holiday season to be strong, but you don't want it to be too
Right.
strong, right?
Yeah. That CPI is coming out tomorrow, right? CPI, I think, will be down tomorrow.
Yeah. Well, like better than I do, so I guess we'll see. I would tell you that in an ideal world, I think you probably get 2 more rate hikes, probably petering off, hopefully in February-ish. It could be 3. Depending on the data you get. And then I think you're just going to be in a plateau for probably 6 to 9 months. Jerome Powell he's been very, in the Fed, they've been very direct that they're not going to lose the fight to inflation. So I think that in order to do that, what you're going to see is you're going to see an elevated rate environment probably through 2023, and hopefully it starts to trickle back in 2024.
Yeah, right before the presidential election. So
isn't it amazing how these things happen, isn't it?
Okay, so question I'm asking everyone. In South Florida, are we going to see a recession?
Listen, I think when you say recession, that's a technical term. So sure. I mean, sure. I think it's just a technical term, right? It's a domestic term, but I would tell you, I think out of every market in the country, potentially the world. I mean, we had our global executive committee in town last week, and I'm not so sure that this isn't one of the hottest markets in the world today. And now I'm not talking about from a temperature perspective.
Exactly.
I'm talking about from a real estate investment perspective and just an overall fundamentals perspective.
At the Real Deal conference, I think last month, someone said, winter is coming, but not in Miami.
Exactly. That's well said. That's a great quote. So yeah, I think that's very accurate.
I didn't say that. I heard it. Okay. So there's a lot of people that are listening now that will be listening on the replay. How can people find you the best for you to help them get loans on their $100 million assets? Not me.
No, we do $5 and $10 million assets as well, Beth. Don't ever forget about that.
So
it's
how can they find you?
Sure. Chris.drew, CHRIS.DREW @JLL.com.
Got it.
Or you can call me at 305-421-6551. I appreciate it. Thanks so much, Beth.
305-421-6551. Excellent.
Thanks so much, Beth.
Chris,
Always great to see you.
You
Cheers.
Bye-bye.
Say hi to Tere for me.
I will. My friend.
Beth, what's up? Virtual hug.
How are you?
Good. How are you?
All right.
You're so much fun. Always doing such fun things.
So much
Informative.
fun.
You're the best.
We have Mitch Feldman here, the president and founder of the Feldman Companies. I wonder where you got that name from.
Very
And you
creative.
are a developer of self-storage.
I am.
Do you also acquire existing?
I've never bought an existing operating property in my life.
Okay,
And it's a funny story. I wanted to when I first started, but I had no money. And investors were like, well, what do I need you for? I'll pay you commission. So I figured early on that I better learn how to create value so I could get investors. So I started developing and I never looked back.
So how many properties have you developed?
We've done over 2.5 million square feet, over 20. I think we're on our 25th, 24th property. We have.
Congratulations.
Thank you. And we have.
I knew you when. I knew
Yeah,
you when
you knew me well.
started.
You knew me, right. You knew me at 0 properties. Right. And we had I think in South Florida, I was thinking about it in preparation for the Miami market phone call. You know, that we had I think we've got 7 in South Florida that are either in already built, operating, or in construction. We have a few that are in the pipeline. But South Florida is just hot.
Hot. So what are you doing about construction costs? Because we know it's painful.
Very. It's look, we have a strong discipline on delivering to a certain yield. So and if you're disciplined on what is my yield, and you have to end up at a certain place of a return, you can budget your cost if they're higher. You can budget your interest carry, which is today higher. And as long as you're disciplined in getting to the final result without BSing your rents and without, not accounting for costs and, making sure that you're running it right. Yeah, it's harder to find deals because you have to make the metrics work, but you got to get the right land price. You have to be disciplined in your timing. You can't let them go. You have to execute timely. You need longer term contracts. You have time to get your permits. You can't just buy a property and wait. So, there's if you're disciplined, you can still build to the same yield. I mean, it's crazy to say, but you have to also adjust it a little higher because theoretically cap rates are getting higher. So your ultimate value, the space where we live between our all-in cost and our value, the kind of the air we breathe has been shrinking. So if this is going up, you got to push it a little.
So can you charge more rents?
So the good thing about self-storage is that they are month to month. So we're not locked into long-term agreements. And even guys who have purchased storage facilities or built previously, as rates change or as things change, they're able to adjust rents. How much can we push them? We don't know. But storage has had a phenomenal, COVID was actually very good to the storage industry. Rates were high. People weren't moving out. People were moving in. So occupancies went up, rates went up. And sort of the storage used to be the ugly duckling of the real estate industry. Today, it's, it's cats out of the bag. You know what I mean? So people love it. They're talking about it. There's a lot of equity. There's a lot of debt available. And you see a lot of guys getting into it, which is concerning. That there's some overbuilding, and which there is. You're seeing guys who are GCs or guys who are in, kind of third party to the business now buying up sites and trying to build. And, unfortunately, some of them are not going to be in the right locations. Some of them are going to be entering the markets that are already too competitive, and they won't be able to get the price that they think they're going to get or that they need to get to meet their pro formas. So we'll see what happens, but South Florida is strong. So a lot of people are moving here. There's a high demand for storage. Storage is becoming more and more in demand year after year. And thank God it's been a great industry.
So will you continue to develop and not acquire?
Yes.
So
Until until I can't. I mean, if I can responsibly build, I'll keep building. And I think that the way we operate, a lot of guys, their secret sauce is, when there's a property available or a building available, the only way to get that piece of already zoned land or something that's on the market is by paying the most for it. So that's not a
That's the
skill
trick.
set. Yeah, that's not a skill set that I'm trying to develop, right? You know what I mean? So our skill set, our secret sauce is finding properties that have environmental challenges to them or have zoning issues or not zoned, or you must go through, land use issues, or complicated stuff. And that's my background as a real estate attorney. I'm comfortable in that environment, but we do deals that people have had under contract and can't get done. So when we build something, it's because other people probably couldn't. And if we're a storage guy, I always tell everyone I can't compete for price. If I'm locked on a site and a multifamily guy comes, or a retail guy, or an office building guy, or anyone could pay more than a storage guy. So
Right.
if I'm getting a site, it's because I'm getting the right price and because it's complicated. And by doing that, we're creating assets that are irreplaceable, that really do have strong value. We're creating value just through the entitlement process.
And are you you said that sellers will give you the time to go get those entitlements?
To a point, but the properties we find are challenging. So a lot of times the sellers have already been through one potential buyer that dropped out, or a second potential buyer that dropped out, or is aware that there's an environmental issue, and they'll give us time, and we'll go hard on deposit. So I'm not afraid to put my money where my mouth is and get a seller comfortable. So we'll execute, but I don't want to buy a property that I can't develop storage on. That's the townhouse property, so it's got to.
What's your typical size
So
of acreage?
it varies in market. So we have one in downtown Miami on the Dolphin Expressway, right across from Jackson, and like that Spring Garden side. It's on Sunnybrook, where we built an 8-story self-storage facility. Our footprint we were on 16,000 square foot lot, and we had a 13,000 square foot footprint when we went 8 stories up, 112,000 square feet. So I can go that small in a downtown situation. Today, I think it would be very expensive to build that and very difficult. But typically when we're in a normal location, we'd like to build, sweet spot is a 3-story building of maybe 120,000 square feet. So whatever we need for that, maybe 2 acres. We have another one we're doing now that's 5 stories, and they're all different. But we'll do anything if the numbers work. It's all on the numbers.
Are you seeing any opportunities with mall properties?
We did in outside of Philadelphia. We bought a Walmart that was inline space, and Walmart moved out to build a super Walmart. So the owner of the shopping center was left with it was like a China buffet, a Dick's outlet, it was
What's
and the
wrong
big
with the
box.
China buffet?
It's great. If you like Chinese food, you go to China buffet. So it was just an inline space, and we condominiumized with the seller. We condominiumized the property. We bought the Walmart with part of the parking field, and we converted it to a drive-through self-storage facility. So in the Northeast, where it's snowing and it's you want to be inside, we created this drive-through aisle with evacuation systems for the car exhaust, and it was every unit was an interior climate controlled, basically drive up self-storage unit, and it was phenomenal. It was a great property. We did the same thing with a Kmart in New Jersey. So we bought a Kmart, condominiumized it. That was next to Planet Fitness and a pizza shop. So
A drive-through self-storage in
Yeah.
cold weather cities. I love it. I love
Yeah.
it. So is it your preference to try to do something in your home market as hot as it is? Because my guess is you can charge more, or would you, it doesn't matter and you'd go do something in the Midwest because it's a good deal?
So we have one in Indiana. We have we've been going all over the place. We're in Maryland now. We're wherever there's a market for storage, wherever we can find a deal. We kind of have a funny rule of thumb to markets, and it was started as me being sort of. It started with me saying, "Listen, I'm willing to get in an airplane flight." No one stop, straight,
Nonstop. That's called nonstop.
a nonstop flight to any city, and I'm willing to drive about 45 minutes to the property. That was my market. And
So
if
they
you
did
think
math.
right. So if you think about it, any city that's really a nonstop flight out of Miami with a 45-minute drive, that's a good market.
Absolutely.
Right.
So what about these? Will you do like a conversion of a B or C office building? Will you do conversions?
We've looked at office to convert, but the floor loads don't meet the same loads for storage. So you have to beef them up a lot. In the Northeast, they've had like these mills that were industrial properties that have very heavy concrete floors. So they're more conducive to adapting. We did in Hialeah Gardens years ago, we took an industrial property that was like a 22,000 square foot. Oh no, it was a 40,000 or 45,000 square foot warehouse, and it had 24-foot height ceiling. And we put in a mezzanine deck, an elevator, and we turned it into like an 80,000+ square foot climate controlled. And then because we didn't need the parking and the loading outside, we built some non-climate controlled. So we've done them and they're available, but everything's competitive to try to buy it.
So I have been spending a lot of time in Cleveland, and there's a lot of those mill buildings there.
Yeah.
So you can get on a direct flight from Fort Lauderdale on United to Cleveland.
Right.
I go every
That's
month. So on my next trip, you should come and I'll show you. There's
I'm coming.
probably some opportunities there.
I'll come play with you.
So delinquencies. So except for South Florida, right? You would agree. I can't imagine you have any delinquencies in your South Florida product.
I mean, there's always some delinquencies, but storage, people can take their stuff out. So it's a month-to-month lease, and they'll come and take it out. So the delinquencies aren't so bad. I mean, maybe, and even
Are you full? Are you full? Is your occupancy full in South Florida?
Typically, they're over 90% to 95%, which is where you want to be.
Is it higher in South Florida than other markets?
Not necessarily.
Because there's so much.
South Florida's strong. Florida's strong generally, but big cities, there's a lot of movement. So I think if you're in the secondary and tertiary cities, maybe it's a slower lease up, slower. Maybe have a little more vacancy or in and out. College towns tend to be, cyclical with summertime versus Tallahassee, exactly. Gainesville, of course,
Right. I've got my water right here. No.
Right. Or in Miami, with the hurricane. I have all my Miami hats here.
What happened to the Dolphins last night? So anyway, okay.
Hold on. Did you say Dolphins?
Do you have like a row of hats right there ready for me?
Sitting right here. Keep going.
So are you seeing delinquencies in other markets because of the so-called recession these other markets are having, unlike Miami?
I don't the storage, they call it the recession resistant asset. So it really has proven itself in '08. It proved itself during the pandemic, and I think it's going to prove itself now. So occupancies are pretty strong. Storage, when you ask someone, hey, how's the market going? And you ask a retail person. So if I ask you how the market was, you'll talk, well, there's been some challenges maybe with Amazon, or, people are staying, maybe they're not eating in restaurants so much, or you'll talk about the business. When you talk about office, you'll talk about, people want air systems and people are home. Now they're coming back. When you ask a storage guy, how's the market? They don't even think about the business. They're like, well, interest rates are a little higher. They talk about the market fundamentals, not their business fundamentals. Storage is it's doing great.
Well, does anyone do long-term leases, like a year lease for storage? No one.
No.
Why?
Maybe they'll do. I don't know. We don't do. Maybe some guys will do it for like one customer, or maybe someone who has like a car, a truck.
But if I came to you and said, I'm moving out of my 5-bedroom house, I'm an empty nester, I'm going to go to Las Olas, I'm going to try the condo thing, I'm not sure it's going to work, so I'm going to put all my crap in self-storage, and I want to sign a 1-year lease, I'll pay you for the year up front. You wouldn't give me a 1-year lease in a self-storage and put my stuff in it?
I really haven't seen that, and not in our properties, not with our management company. It's month to month, and and your rate's going to change. It's going to go up in 3 months or 5 months, and it's what your entry level rate is going to be different. And
I gotcha. So are you getting calls from these roll-up companies that they want to buy your 27 deals?
All day.
Every day, all day.
Yep. There's massive money chasing storage deals. I think it's look, buying an existing facility today is harder because the seller still wants his low cap rate, and the buyer's forced to pay higher interest rates. So there's still there's a mismatch today.
That happens in all the asset classes.
Of course.
That's happening
in mismatch. There's a mismatch, but we'll see. It'll balance. Some guys who bought too expensively a few years ago or a year ago on maybe a value add play and have adjustable rate mortgages, they might be in a little trouble trying to sell some assets.
And you don't want to buy them. If they get in trouble and you think it's a good location, you're not going to buy it.
It's not my.
Not your
I would steal it, but then again, there's a guy who's going to pay. There's a guy whose skill set is paying more than me. There's a guy out there who's got a better skill.
The smartest guy in the room never gets the deal.
Right.
All right. So predictions for 2022 in self-storage.
So I definitely think there's going to be a slower rate of construction of new product. I think we're already seeing that. I think a lot of guys can't get financing. A lot of guys and gals are concerned about the rates. So I think it'll be slower. We're still going in, head first. We're getting equity, we're getting debt. And like I said, we're managing to our investor yield. So I'm comfortable with moving forward. I think we're seeing the cost actually on steel came down a little. I understand there's going to be an increase in concrete in January. So, there's changes, but we're going to keep rolling. And I think storage will stay strong. I don't think rent rates are going to increase at the robust rate they have been, but I do think we're going to still keep seeing increases, just modestly. And I think if we're budgeting our numbers appropriately, I think the business stays strong, and we keep moving.
So I just got a text that Sam Bankman-Fried got arrested in the Bahamas.
Really?
Okay. On that note,
I have no cryptocurrency.
Right. Yeah, me either. Okay, so before we move on to Tere, I've asked everyone the same question. In South Florida, are we going to see a recession?
So I heard you ask a few before me. So I think technically I think we're already in the definition of a recession. But I think the answer is yes, we're in a recession. But if you walk outside or you make a phone call, I still can't get a reservation at Carbone or at Kiki's or at,
Well,
at Aqua
did
and Bell Harbor.
you hear Lyle Stern is going to take us all to those
Yeah,
restaurants?
you can't get rested. You can't get reservations. You know what I mean? So, I think, so, you got to know the maitre d'. So, it's.
Well, you got to do more than know them.
Right.
That's how.
So,
well,
look,
Lyle did the deal with them, so he's going to get us in.
Right. So, I mean, you go to the mall right now. I'm trying to pass by the mall, Aventura Mall, and I mean, it takes me 30 minutes to go from the south side of the mall to get past Ives Dairy Road. So, I mean, what recession, right? So,
right. Okay, that's the answer. We're going to end it on that. So, and by the way, Lyle just popped his camera back on in the queue and went like this. So, Carbone, he's going to get us in. Okay.
Thanks, Lyle.
Right. Mitch,
put me up, baby.
So, if anyone that's listening, the thousands of people that are going to watch this have some property that is a direct flight from Miami or Fort Lauderdale and 45-minute drive, and they have land to sell for a self-storage developer, how would they get in touch with you?
Just hit me up on LinkedIn. I'm the easiest guy to find. Just Google my name.
Well,
there's
got to be more Mitch Feldmans than you. So, okay, LinkedIn,
no.
Mitch Feldman. All
hit
right,
me up
thanks.
on LinkedIn. I'm there.
Thank you. Mwah.
Love you.
Love you. Bye. The woman we've all been waiting to talk to. Hello, my friend.
Hey, how are you?
I am doing awesome.
It's so good to see you, Beth.
It's so good to see you. We've been talking about office. Almost every person that we've spoken to has brought up the hot Miami office market.
Yeah.
And I keep saying, I'm going to have the expert. She's coming.
Well, thank you. Thank you for that. And it is hot. That's for sure. It's sizzling hot. And I keep saying that to everyone who tells me that lenders don't want to touch office. And I say, but you're not in Miami. You don't understand what's going on. You got to put out some money because we're running out of quality office. And there's certainly a flight to quality. We'll talk about that. And,
so let me properly introduce you. So Tere Blanca was the founder and is the president of Blanca Commercial Real Estate, which, by the way, she started in the middle of the global financial crisis in 08-09, and is the preeminent office brokerage firm, I'm going to say that, in South Florida. And we are so happy to have you. During COVID, I called Tere. I said, how's it going? And she's like, no worries. You would not believe, this is early on. No worries. We're getting calls you wouldn't believe, right? Yeah. I was like, awesome.
So yeah, listen, March of 2020 was certainly a scary time for everyone, right? For many reasons, not just in terms of business, but our health and our families and so on. And we went home and started having Zoom meetings every day at noon. And first thing I said to everyone, listen, no one has to worry about their job, right? We're going to be secure. We're going to be fine. And the other thing I want to share is that I've lived through 3 different cycles in Miami, and each time, really challenging cycles. And each time we come back stronger, and we're just a resilient community that benefits from, this diversification of business and our demographic population and our geography and everything that, over the last 30 years we've witnessed in terms of government and private sector making investments in culture, in sports, in music, in the Bright Line. Everything that's happened over the last 20 years has positioned us for this moment in time. And the moment in time is that, yes, during COVID, people started migrating here. And, that could happen. And it's happened all over, South Florida throughout the years. But what employers decided to do was to start speaking with their employees about why they were there and they were not coming back so quickly. And everyone found out that people just love living here. And they found that the quality of life and also, just the ability to be in a global environment, not only Miami, but Fort Lauderdale and Palm Beach, was really well received by executives and employees. And so, we did that Blackstone deal in October of 2020. And I remember saying, quote unquote, team, brace yourselves. What's coming is an avalanche. And, we didn't have to be that smart to know that. But when Blackstone puts their stamp of approval with 40,000 square feet in downtown Miami, we just knew it was coming. And it hasn't stopped, Beth. It's just been a fabulous 2 years. And, certainly it's been a little bit of, the tale of two cities where 80% of the demand started in Miami, most concentrated in Brickell Avenue, which is our financial district. But then it starts to spill over, which is the case each time, right? So we're seeing it at Waterford Business District and Miami Airport. We're seeing it in Coral Gables and Aventura. We're seeing it in Wynwood. We're seeing it in Miami Beach. We're seeing it in Fort Lauderdale. I mean, we leased the main last less than 18 months to 100% after delivery. It's just insane. So just with great tenants, and a third of them were, companies migrating to the area that did not have a presence in Fort Lauderdale. So when they say that Fort Lauderdale gets skipped over, please don't believe that. It doesn't. And it is becoming front and center in the conversation with many companies around the country as well. It is a great place to expand your business into as well. So it's exciting.
I have a couple stats, and this is all such phenomenal news. Okay, so I heard a stat on Friday that 2 million net new square footage has happened in the last year in South Florida. And 3 people on this call said, you're wrong. It's way more.
It will be at the end of the year. I mean, listen, our company alone has signed 2 million square feet year to date.
Oh my God.
Okay. That's insanity, right?
And so we usually
we average about 1 million square feet a year across our portfolio and our tenant rep practice. But this year we've doubled it, and we have more that's in the pipeline through the end of this year. And so when that's Miami-Dade County and Broward County primarily, right, with our presence throughout these counties and some tenant rep in Palm Beach as well. But it's really like us. Every company has experienced tremendous volume, and we still have a pipeline of about 3.5 million square feet of deals in the market, of which about 25% are new companies coming into the market. We're fielding calls every day across the portfolio of companies that are, still coming in. And it's this following effect that we expected after Citadel and other top financial services announced their relocations or their opening of new hubs in Miami. So, we've seen all the top law firms in the country like Kirkland & Ellis and Winston & Strawn and Alston & Bird open major footprints here and make commitments long-term for a lot of space. So many partners are raising their hand and saying, we want to live in Miami. They're recruiting, of course, locally, but they don't expect to fill all that space only with Miami recruits or South Florida recruits. Partners want to come and spend a lot of time here. And so it's really, it's a transformation that now, of course, is going to take us to a place of, all right, what do we need to do throughout the region to be ready for this amazing growth? Because of course we need schools, we need mass transit that works not only in the urban core east of 95, but across the region, east and west as well, and we need housing supply that will stabilize rents a bit, because certainly on the residential side, I'm sure you heard about this too. The rents have peaked quite a bit. So all of that is a supply demand imbalance, and we need more office trophy assets. Nothing is going to deliver in the next 3 years in the major markets throughout Broward and Miami in terms of the urban core, and really in the suburban markets, very little. So the companies that are migrating here, even the companies locally, because there's going to be some shifting around of local companies that might choose to be in the suburban markets, to be closer to their executives, to be closer to their employees, to reduce the commute time, because that's part of bringing people back to work, as well as, for instance, companies that, really are looking at their occupancy costs and saying, well, Brickell we love, but we can't pay $90 to $100 rents, or don't have to, right? And so we're seeing this shifting also, and to accommodate those needs, we need quality assets. And so we're delighted at Waterford. We have the ability to do a large block of contiguous space of 100,000 feet or more. And we've got, built-to-suit opportunities for quality companies that will accommodate those larger requirements that don't need to be in Brickell and choose to be somewhere else and closer to their employee base. So very excited about having that product available in the urban core. We need new office, and it's not going to happen for a while because there is a challenge today for construction of new development projects, both from a cost standpoint and as well as, of course, the lenders pretty much being out of business of funding office developments are all across the country for regulatory pressures or other pressures, maybe weighted too heavily on office in certain sectors. And so to build new office, it's going to require pre-leasing, it's going to require very solid sponsors, and it's going to require a big lift and hopefully costs settling down a bit, because it's been that's a big challenge.
So someone else, another stat I heard on Friday morning, I went to the South Florida Business Journal's market update, and they said that there are no, this is the quote, no caps on rents in Brickell. No caps. Is that, you support that statement?
I support that theme. I mean, I think that for the next 3 years, we're going to see a very strong owner's market, right? I mean, the vacancy rate for Class A, we categorize Tier 1, Tier 2. So the Class A Tier 1 has less than 5% vacancy. I think by the time we close the year, it'll be less than that. And Class A Tier 2, it's already at about 11%. And again, continuing to lease up. It's already, so the rents have doubled in over a period of 3 years, let's say. And the big lift was certainly year over year with almost a 30-40% increase. 830 Brickell, is delivering in the first quarter pretty much full at 100%. And then we've got in downtown Miami, a lot of action for the top tier assets in that submarket. So, Southeast Financial Center, One Biscayne Tower, they're experiencing really healthy leasing, and rents, of course, are indicative of that as well, because landlords are pushing rents there too. So over the next 24 months, downtown will be a strong beneficiary of the activity that is happening. We will see that tenants in Brickell that are rolling over the next 24 months that do not need to be in Brickell centric will start migrating to Coral Gables, to Waterford, to Aventura, some even to Fort Lauderdale. We're seeing some of those, some Canadian companies that are in Brickell looking to acquire space in Fort Lauderdale instead, to be closer to where the employees and the executives reside, and to be in a different, urban environment than Brickell, a little calmer, less traffic. So I think there's huge opportunity for new office, and I think there's huge opportunity for the entire region to benefit from what is happening, not just Miami. And so
the legacy tenants that have been in these markets paying these lower rents, and in the beginning of COVID, when there was this question mark of are workers going to come back? So those folks, where maybe the building owners were like, oh crap, what am I going to do? Now they're like hoping that those tenants raise their hand and say, yes, we don't want 50,000 square feet anymore. We'll take 10,000 and we'll move out to Doral, right?
Well, there's certainly an opportunity for, to be strategic in terms of how you're going to manage your portfolio and your assets, right? From an ownership standpoint. And from our perspective, that's what we help our clients think through, and how to provide opportunities within their portfolios to leverage what is happening in a good way, and help tenants as well find their way, to places where they're more comfortable. And so we've certainly executed on those strategies for many of our clients, where tenants have said, well, maybe we don't need to stay here through the end of our term. And if the landlord is willing to participate on either a contraction and extend, or let's just figure out a termination that makes sense for you and for us, and you have a tenant at hand that is willing to pay premium above what we're paying, why not execute on that strategy, provided that, of course, the capital required to execute on that new lease makes sense for everyone. So I think there are many opportunities, both for tenants and owners, during the next 3 years, to figure out ways that serve each party well.
Did you add to your team during this time that you went from 1 million
Yes,
to 2 million?
we have. Over the last 3 years, we've doubled our team. We're 42 now.
42?
Yeah. So out of 42, however, 14 are in our property management services group. We've also grown our our portfolio in property management for office and high street retail. And so very excited about that and continuing to grow that area of our business. And our advisory practice for both investment sales and for companies that need office and industrial space has grown significantly over the last 3 years as well. So we have a great team in place executing on both those areas of our business and continuing to grow. Very excited
Amazing.
about the future of our region and a big part of it.
So I have three more questions. One, do you think the billboards that went up in LA and New York from Mayor Suarez contributed to this craze that we're seeing in South Florida?
I think it did. And the reason that I say that is that I hear feedback from companies coming from California and Chicago and other places that say we are really happy to be in a place where we are welcomed, where we feel welcomed, where we feel that we can contribute to the community and to business, and that we're well received. And certainly our region and Miami in particular has been a place where they feel like everyone has been welcomed with open arms. I think historically Miami has been a place of that has grown its population with a lot of international immigration. But now that we're having this immigration from New York and Chicago and California, LA, San Francisco Bay Area, et cetera, it feels that we're at a different stage of growth where it feels we quote unquote, from Morgan Stanley's real estate head, Lauren, the other day at ULI, Miami is officially a gateway city. And this is a major gateway city along the lines of New York and LA and others. And so that's huge for Miami, but it's huge for South Florida because it is a metropolitan statistical area that is fully connected and integrated, both from a business standpoint as well as a population standpoint, as the Bright Line and other commuter rail opportunities, continue to develop to connect us more as an MSA, the more we all win. And the more we should collaborate to make sure that these wins impact every city in or MSA.
Absolutely. Okay, so the last two questions. One, your predictions for office in South Florida in 2023.
My prediction is that from an office standpoint in particular, we will continue to see companies execute on leases for space here, and they will continue to come from New York and California and Chicago. Now we're seeing them come from Europe and more from Latin America, given the dynamic of the political situation across the region in Latin America. We'll see more companies coming from there, expanding their presence here from Europe. I think there's, certainly this war in the Ukraine and Russia has caused certain companies and industries to look at how they expand their presence in the U.S. And balance a little bit where they're doing business and where they house executive teams. And I think that we will see less development than I would like to see, given the challenges that we have with the capital markets tightening, and I expect us, to address successfully from a political leadership standpoint the challenges that we might have, which are opportunities in terms of residential housing that is well balanced for a varied demographic that comes here. Right, it's people from all over and different compensation levels that need to live and reside here. So I think we'll find opportunities to solve for that. And also schools, K through 12, both public and private sector need to be addressed. And I think that we're going to see collaboration between private and public sector in ways that perhaps we haven't seen before. We're seeing it from already.
As retail, we've been hearing for the last year, once New Yorkers started moving down, private schools calling for space because the parents are demanding that. Mm-hmm. So that we are seeing that since COVID. I started investing in some Little Havana multifamily, some smaller units I think that worker that's going to be working on
Yeah.
rental, it's
Yeah.
awesome.
I think
So-
so. And I think there's going to be a lot more rental housing opportunities. That's not going to go away. It's the one challenge that we don't talk about too much. But I think, I guess they're talking about it in the newspapers a lot, but certainly the cost of insurance, we can't ignore.
Oh, yeah.
And
For
so
sure.
that usually gets passed through to the tenants, and it gets passed through to the renters in apartment housing and so on. But it is, it's a challenge. And I think there's some discussion going on in Tallahassee, right, in terms of how to solve for it. Hopefully, there will be solutions coming up soon, because it's getting to be something that it's a challenge.
So I've asked everyone this. Will there be a recession in Miami?
I don't think so.
I agree. No. So Tere, thousands of people are going to watch this, and they need representation from a strategist like you and your team of 42.
Thank you.
Congratulations. What's the best way for someone to contact you for space in South Florida office?
Sure. My email, Tere, Tere, Blanca, Blanca, at blancacre.com.
Tere Blanca at Blanca CRE.com.
Right. Tere.Blanca at blancacre.com. And
my friend, thank you so much.
You.
We'll
see you
soon.
It's great to see you.
Merry Christmas.
Merry
Happy
Christmas to you too. Bye-bye.
Bye-bye. Mr. Larry. Oh, you're muted.
Sorry about that.
We want to hear your words of wisdom. How are you, sir?
I'm excellent. It's good to see you.
You too. This is Larry Genet, EVP of CBRE Industrial.
That's right.
If you're in South Florida, you know him because he's got the big leasing signs with lights on at night.
That's right. That's right. That's right.
See,
we started that trend.
You don't think I follow you on social?
I know you do. I know. Everyone sees it. No one wants to comment, though. I don't know what's up.
I love it. I tell my kids, I know that guy.
Right. Awesome.
His names are in lights.
Bring him by the office one day. We'll have some fun.
Absolutely. So industrial.
Yeah.
Fire in
Rocking.
South Florida on fire. 3 years ago, before COVID, I was at a CCIM Outlook thing, and Michael Silver got up and said something like industrial rents were in the double digits. And I went, what?
Yeah.
And for me, 36 years in the business, that was never the case. So give us what happened in 2022 or 21 in industrial in South Florida.
Yeah. Just COVID accelerated everything. So rents went crazy after the lockdowns kind of subsided, and Florida remained open thanks to our governor. Just rents went crazy. Small bay industrial, really on paper, in a situation like that, should have gotten absolutely decimated and crushed, and all those businesses should have closed. But instead, it was a flood and a rush. And then when you had all the inventory issues building up and people couldn't get their inventory, they started taking on more space, which just added to the problem of limited vacancy. So right now, South Florida is sitting at a 2.8% vacancy rate, 2.9%, which is effectively full.
Wow. So historically, you've been in the business how long?
So, I've been in the business my whole life, but I've been at CB 10 years now. Well, 11 in January is my anniversary.
So in 11 years, on average, what used to be the on average occupancy?
Oh, it's 6%, 7%.
So 2.8% of vacancies, crazy low.
Yeah.
And rents have gone up, right? So what percentage have rents gone up in the last 12 to 18 months?
In the last 12 to 18 months, I guess they probably went from, $9, $10, $11, depending on where you were, triple net, to $13, $14, $15.
Crazy.
Huge jump. Yeah.
Is there any new development of industrial, or was there before the construction costs got crazy?
we've always had a pretty steady new construction pipeline. They build it as fast as they can find it and get it out of the ground. Unfortunately, it's taking 2 to 3 years to deliver product these days. So it's a natural barrier to an increased vacancy factor because you can't deliver it. Therefore, there is no vacancy. There's no new product. Anything that's getting delivered is getting, 20, 30, 50% pre-leased, generally speaking, which historically never happened in South Florida.
Never happened. And then are you seeing people add to their square footage, like HVAC contractors, people buying in bulk? Like you mentioned that. Is that what you're talking about earlier? Yeah. So
yeah, it's been huge.
Yeah, because those developers or those retailers or those general contractors who need the stoves, the HVACs, all of these things, they're hoarding it now and they need somewhere to put it.
Yeah, everyone needed more capacity. So people band-aided the situation and they took a space next to them or took a space with another owner or space nearby or next door or whatever. But at a certain point, it's just so inefficient that you've got to get under one roof. And there was a huge flight to quality. And anyone who could afford it took all their spaces, their 2, 3, 4 spaces, wherever they were, whether they're next to each other or throughout South Florida, and they combined them into one. And they all moved into Class A 32-foot clear, rear load dock high buildings. And, so in some cases doubled their space. It went from 30 to 60 or, 60 to 120 and that kind of a thing.
So we have to talk about the guys, the Amazon guys. How much do they have? How many square feet do they have in South Florida? Do you know?
Oh yeah, I'm actually not allowed to talk about that.
Oh, you're not. Oh, okay.
Yeah, sorry.
That's okay. No problem. There's a lot, so I can talk about them, but you don't have to comment.
Yeah.
There's all this talk that they're giving back a bunch of square footage, but the numbers I have heard is that the stuff they're giving back is because they're growing into more efficient space. And let me see, I have these numbers. I just want to tell okay. What I have heard, they have 110, just in Miami, I think in the US. I think these numbers are in the US. 110 million of existing warehouse space, and they have 400 million on the books, compared to Walmart that has 10 to 13 million.
Yeah.
So you don't have to confirm that or deny that, but I think they're still going to be a very large user of industrial space going forward.
Oh yeah, absolutely. They're going to catch up with their supply chain and they're going to continue absorbing space for the foreseeable future. I think they're just catching up to where they need to be. And the sublease space that they've put on the market is not going to change or, erode any pricing or anything like that. So it's on the market right now. It'll get leased up. They've got very low rents in place because they signed their leases so long ago. So that'll be cheap space. It'll get gobbled up really quickly and it's not going to affect anything down here.
So what's going on with like the C and D or the B minus C product out there? Are people buying it, assembling it? Are they going to knock it down, rebuild new? What's going on with that product?
Yeah, it's too valuable to knock down at this point. So none of that is really happening. Chris Drew hit the nail on the head, and he's where the market is, and that's where I've been my whole career, which is interesting. So I'm glad that everyone's kind of coming in my direction, which I love. So we sell a lot of those, 10, 15 and under $1 million deals, whether it's on market or off market, just organically cold calling and knocking on doors. And those things are moving.
Wait a minute, you cold call and knock on doors?
Oh yeah, all day, every day. And my crew.
You could be called the canvassing king.
No, I won't take that title. I won't take that title, but we do plenty of business and we're having a great time. So we're under contract and have just closed around 5 or 6 deals for the end of the year. So we've got a lot that's happening, and we're more active than most because of the space that we play in, and the fact that we're well diversified and nimble, and we can jump in front of these opportunities before anyone else sees them.
So you're cold calling these B, C, and D product. They are too valuable to knock down. So someone's buying them, and are the groups that are buying them users, investors, or future assemblage people?
It's all three. You've got the aggregators who are building a portfolio to then later sell to a larger fund who can't buy these one-off deals like that. It's a lot of users, probably 2/3 of the deals we have under contract for the end of the year that are closing are user deals. And then of course, just the standard, investor who's just buying a deal here or there. It was
like
a lot
me and
of,
you, like you and
yeah,
me.
right. So anyone who can scrape together a couple of bucks is taking a hard look at the market right now. When everyone's got a lot of fear and their pencils down, and investment committees are saying no, it's time to say yes.
Absolutely. So are people saying no?
Yeah, a lot of funds and institutions have paused to see where the market lies. They feel like things could potentially come down and pricing could be reduced. I mean, interest rates went up pretty significantly. Cap rates went up pretty significantly. So that has affected the market. There's no question about it. But on the flip side, leasing has never been stronger. And every deal that's getting signed is higher than the last deal that was just signed. So we've got incredible rent growth. We've got no vacancy to speak of, really. Anything that's getting built is getting absorbed, and the market is really fundamentally very strong. It's just the whole interest rate cap rate spread is what everyone's trying to figure out. So I think the more cautious people are on the sidelines, and then the more aggressive people are buying everything they can get their hands on.
So were you on I don't know if you were listening, but Barry Wolfe was the first speaker, and he talked about how Tampa has leapfrogged to be the number 2 city behind Miami in the state of Florida by, I don't know, some stat that he found.
Oh, interesting.
That's a port city, obviously. And with my retail hat on, because I'm not industrial, I presume port cities are great for industrial. But do you guys?
That's why Miami has been crushing it.
And
they've seen a lot of that. I mean, I would say, probably around 30% of the deals that were signed nationally were 3PLs.
What's that?
So
what is
third party logistics firms?
Oh.
So they're shipping things for other people. So things are coming in, they're getting racked, and they're going back out. So it's been incredible. Anyone who really understands industrial real estate and wants to own it or invest in it is really focused on any port city, really anywhere in the country. New York, New Jersey, LA, Miami. So big
Tampa.
Port cities are
Tampa. So
Sure.
do you do work also? Are you seeing the high occupancy, low vacancies also in Fort Lauderdale? I don't know if there's any industrial in West Palm or in Jacksonville. It all in Tampa, right? So how's the rest of the state doing?
Yeah, I'm really just a South Florida guy. So okay. I mean, Broward's at 3%. Dade is at 2.8%, and Palm Beach is at 2.3, 2.5% vacancy right now. So they're all effectively full. And, Dade is the biggest market by far. And then Broward is about half the size. And then Palm Beach is about half the size of Broward. So as you go north, you get smaller and smaller in terms of the industrial supply.
Have you added to your team in the last year?
Oh, yeah, we've hired a bunch of people. I would say over the last 2 years, we've probably hired five or six people, I would say.
So on a side note, you posted something, I think on LinkedIn, that you said, students never call me and ask for advice. And I must have sent that to 10 students. Tell me they all called.
Some of them called, some of them reached out. I still have to get back to a few of them, but I'm going to wait and see how persistent they are.
I said, be careful what you wish for, right? All right.
No, I love those calls. I love helping out and doing anything I can to help anyone out there. And that's why I make all this crazy content. It's not for me.
All right. So 3 quick things. 1, your prediction for 2023 in industrial in Miami.
Yeah, I think Q1 and Q2 are going to be slow only from the standpoint of there's no space. Q3, Q4, there's going to be a delivery of quite a bit of space that's been in the pipeline forever. We have a lot of that product.
Perfect timing for that guy.
Right. It is perfect timing. We have a lot of that product. I would say.
Is that Prologis stuff?
It's everyone. It's Prologis. It's Bridge. It's Link. It's everyone. Modlo. So, we're excited about that, to have some vacancy to actually lease, because it's sort of a log jam right now. There's really nowhere to go. There's no upgrading of your facilities anymore. And anyone who has space left is asking really strong rental rates, which they should be, from 16 to really 18 triple net for new buildings. And there's just not a lot of options. There's couple in Dade, maybe 2 or 3. There's 1 or 2 in Broward, and that's it.
Tenant rep brokers are calling me every day asking me if I have 25 or 26 expirations. And I say, well, if I did, I would not be negotiating with you now.
That's awesome. Yeah, little trade secret. I'm ahead of my renewals 2 years in advance, just because like everyone else is a year out. I don't want to be 2 years out. I just want to get ahead of them. So I don't mind sharing that, I guess. But that's served me very well.
So my last question, which I've asked everyone, you've heard because I've seen you there. Is there going to be a recession in Miami?
No. No chance. I mean, things are ripping. Have you gone by Aventura Mall or Bal Harbor Shops or tried to go eat in a restaurant or, I don't know, go to the movies? Like everywhere's packed and people are walking out with bags of stuff. So, I mean, yeah, I think the amount of Amazon boxes have increased lately to my house than decreased. So, I think the market's going to continue to rip in South Florida. And I think the interest rate thing has to figure itself out, obviously. So we'll see where that lies, but people will work within the confines of what they're given by the market and they'll figure it out. So I think the velocity of sales may pull back and there won't be as many, but there's still going to be plenty. I would say it's gotten back to normal rather than it being this hyperinflated environment. It's more just kind of what it was before COVID, which is perfectly fine with all my clients.
Absolutely. Okay, so before we go to our next and last speaker, if anyone wants to know anything industrial in South Florida, how is the best way for them to get in touch with you?
You can just Google my name, Larry Genet, Genet, and you'll have pages of stuff. Or you can hit me up on LinkedIn also.
LinkedIn. Larry, thank you so much. And now Lyle's going to take us all to dinner at Carbone. You saw that, right?
I'm in.
Okay. Thank you so much.
All right. Bye.
Happy holidays.
You too.
All right. Our last speaker. We are waiting for her to join us. Are you guys enjoying this? I'm getting so many great comments. There is going to be a replay. Which speakers or what did you hear tonight, you guys in the comments that are still with me? What are you hearing that surprised you or that you love? Isn't it amazing? Everyone said no recession in South Florida or in Miami. Eric, you loved it. Tom O'Laughlin liked Larry's insight. Gina Marie liked the panel. Love the chatting, love the comments. We are going to give our speaker another few seconds. I mean, in suburban retail, we have not, my occupancy is higher than it's ever been. I always say that 100% leased shopping centers, the rents are too low. I mean, yeah, the rents are too low. And I unfortunately or fortunately have 3 of those right now. So I always believe that 100% leased shopping centers is kind of a fat and happy landlord who's happy with having full occupancy and they're not really pushing rents. So for me to have 3 of them full at this moment is a very unique situation. But like I said earlier in some of the interviews I did tonight, I've got tenant rep brokers calling me asking if I have any expirations coming up in 25, 26, 27, and 28. Because in retail, because of construction costs, we are not going to see development for a long time in South Florida. I'm predicting in the next 3 to 5 years, if there's something in entitlements now and they've closed on the land and they're in for entitlements and they can get permitting and the retail tenants will pay the rent for them to get the return on the construction costs, maybe those deals will happen, but we're going to see very few developments going forward because people cannot pencil these deals and construction costs are just crazy high. And the tenants haven't caught up. Now, what you heard tonight with how crazy busy, South Florida is, and for sure, I track all my tenant sales. The revenues of the tenants are higher significantly than they were in 2019. So if the tenants can start increasing their rents and making the projects pencil with the construction costs and the higher interest rates, maybe there will be some development, but nothing like what it was. And with 800 people a day moving to South Florida and $24 billion of wealth moving to South Florida, the demand will stay high for a very long time. And with the supply being super low, I think it's going to be an owner's market from now on for the next 3 to 5 years, which is I'm very happy with, but I would like to buy shopping centers. And it's really hard to buy and certainly super hard to develop because of the construction costs. So I believe Michelle has joined us. She's having some technical difficulties. Michelle, if you can hear me, I did see you connected a few seconds ago. Do brokers get compensated for lease renewals the same as a new lease? No. In retail, typically brokers do not get compensated on renewals at all. I do know that in office leasing, they do. I'm not sure about other asset classes. So, Michelle, the connection was in your link in the email. So if you can go to your email, and I did see you on the camera a few minutes ago. Sorry, I can't connect you. Sorry, guys, for the technical difficulty. Maybe try it again. Do what you did before, because I did see you on the camera when you first joined us. Okay, we're going to try her one more time. Thank you, ladies and gentlemen, for your patience. We're going to hear from Michelle and luxury sales, residential. Unfortunately, it looks like we're not going to be able to connect with Michelle tonight. Sorry about that, everybody. Sorry, Michelle. I wish I could help. I don't know how. I've been trying to do it here. Yeah, I'm sorry. Well, I hope you guys enjoyed all of our speakers tonight. If you did, share when we post this on LinkedIn, share it with your friends. And if you have any interest in coming to South Florida, you have a group of experts that are willing and ready to help you and help you expand your business to South Florida. Thanks, everyone. I hope you enjoyed this. Happy holidays, happy new year, happy and healthy new year. Take care.